Every year you get up to 45% tax relief on your pension contributions, and on paper that sounds like one of the best deals in personal finance. You have paid into it for years, maybe decades, trusting that it was the sensible thing to do, and for a long time it was. But here is a number nobody puts next to it. If your pension pot is already big enough to pay you £50,000 a year in retirement, that 45% relief can end up costing you thousands in tax later, once you actually start drawing the money. What actually matters is not how much relief you get today, but what tax rate you will be paying when that money finally lands in your bank account. The answer depends on 3 specific signs, and once you can spot them, the decision stops being a guess. Each one tells you something different about your own pot, your own age, and your own tax position. Together they tell you whether it is still worth paying in, or whether it is time to close the pension tap and let an ISA carry more of the weight instead. If you have typed something like, "Should I stop paying into my pension?" into a search bar recently, you are exactly who this video is for. I am going to walk through the exact calculation, using real numbers, so you can hold it up against your own pot instead of guessing. And if you are within 5 years of retirement, wondering whether your pension is still pulling its weight, hit subscribe now. I am going to show you the exact point where an ISA starts to beat a pension, and it is not something most of the standard advice ever mentions. Take a 58-year-old with £450,000 sitting in a pension. Convert that pot into an income using today's typical annuity rate, and it works out to somewhere around £35,500 a year. Add the full state pension, worth £12,548 a year at the current rate, and total income lands at roughly £48,000. That is well above the personal allowance of £12,570. Almost every pound above that line gets taxed at 20%, which means around £35,500 of that £48,000 is taxable. Here is the reversal that catches most people off guard. The 45% relief you were promised on the way in is not the relief you actually keep. Relief was never really a gift. It behaves more like a loan from HMRC, and the loan comes due the moment you start drawing an income in retirement. Nobody hands you the repayment schedule up front. Why does this happen? Pension contributions get taxed on the way out, not on the way in. That is the entire mechanism, and it is the part most explanations skip over. The government is not being sneaky about it, it is simply how the system was built from the start. But if nobody walks you through it in plain numbers, it is easy to assume the relief you got at 40 or 45% is the relief you keep. It is not, once your retirement income crosses into taxable territory. If you are in your late 50s or early 60s, and you have spent decades doing the responsible thing by saving into a pension, this is not a story about you doing something wrong. It is a story about a system that changes its terms after you have already committed. The more you saved, the closer you may already be to this exact position, and nobody tells you until you are standing in it. So who actually benefits from that structure? The Treasury does. Every pound you take out of a pension in retirement counts as income, and income gets taxed. The relief on the way in was never designed to be free. It is designed to be deferred, and deferred tax has a way of reappearing exactly when you can least afford to renegotiate it. There is a trade-off worth naming here. The bigger your pension grows, the more of your future income sits inside the tax system with less room to move it around. That gap does not close on its own, it only grows wider the longer new contributions keep landing in the same taxable pot. An ISA does not carry that problem because the tax was already settled before the money went in. But that is only the first sign. The second one is quieter, and it catches people who think they are being smart by spreading their savings across a pension and other investments. There is a rule of thumb worth carrying into every one of these decisions. If you are within 5 years of retirement and the extra benefit your pension gives you over an ISA drops below 10%, the flexibility of the ISA usually outweighs what is left of the tax advantage. Sarah is 58. She was a teacher for 3 decades and she has £450,000 sitting in her SIPP, plus a full state pension on the way. She had been putting £500 a month into that pension for 20 years, and she assumed she should keep going, because 40% relief still sounded generous. Here is what the numbers actually showed her. For someone still on a higher rate salary, with room left in their tax-free allowance, the pension can genuinely win. Put £500 a month in, and with 40% relief, that becomes £833 actually invested each month. Grow that for 5 years and withdraw it in retirement, and you end up with roughly £45,200 net after tax. Put the same £500 into an ISA instead, with no relief up front but nothing owed later, and you end up closer to £33,900. The pension wins there, comfortably enough to be worth the wait. But Sarah is not that person anymore. Her state pension alone, at today's rate, comes to about £12,548 a year, which very nearly fills her entire personal allowance of £12,570 on its own. That means every pound she draws from her SIPP is taxed at 20% from the very first pound. Run the same £500 a month through her situation, and the pension route still nets about £33,900. The ISA route also nets £33,900. The two numbers land in exactly the same place. Her tax relief on the way in gets cancelled out, almost pound for pound, by the tax she pays on the way out. Why does the annuity rate matter here? Because it is what turns a lump sum into an actual income you can compare against your tax bands. Hargreaves Lansdowne puts the typical rate for a 65-year-old on a single life level income at around 7.9% right now, one of the strongest rates in years. Run that against Sarah's £450,000 pot, and it converts into well over £35,000 a year on its own, more than enough to push straight through her personal allowance and into taxable territory before her state pension is even added. I used to assume any tax relief was automatically a win. If the government hands you 20% back, that feels like free money. I was wrong about that, because I was only looking at half the picture. The relief behaves more like a loan than a gift, and for someone in Sarah's position, the loan comes due almost in full. There is a trade-off worth naming here too. The bigger the pot gets, the smaller the gap between the pension and the ISA becomes, and that gap keeps shrinking the longer you keep contributing, right at the exact point in life when flexibility starts to matter more than an extra percentage point of return. So if a basic rate taxpayer with a full state pension gets nothing extra from the pension, why do so many people in that exact position keep paying in anyway? Because the third sign has nothing to do with the maths. It is psychological, and it is the one nobody likes to admit to. There is a specific bias behind this, and it has a name. It is called loss aversion, but in retirement planning it shows up as something more personal, the sunk cost pension trap. You have been told for 30 years that pensions are the responsible thing to do. Your employer said it, your accountant said it. Every article you have ever read about retirement said it. Stopping now can feel like admitting you got something wrong. Let me be clear about something first. If you are in your 50s with £400,000 or more sitting in a pension, you have not made a mistake. You did exactly what you were supposed to do, for exactly as long as it made sense to do it. The system moved underneath you, not the other way round. From the 6th of April 2027, pensions will start counting toward inheritance tax in a way they never used to. The tax-free lump sum limit has not moved since 2014, even while everything around it kept climbing. The rules that made pensions the obvious choice 10 years ago are not fully the same rules you are working with today. So here is a different way to think about stopping. It is not a loss, and it is not giving up on relief you already banked. It is a reallocation. Every pound you move into an ISA instead is a pound that will never be taxed again, at any point in the future, no matter what changes next. That is not walking away from a benefit. That is buying yourself a kind of freedom the pension cannot offer once it is already full. freedom from future tax rises, freedom from complicated withdrawal rules, and freedom from wondering what the Treasury decides to change next. I do not know your exact situation. I do not know if you are sitting on a final salary pension, or planning to retire somewhere outside the UK, or dealing with a health situation that changes your timeline completely. What I am giving you here is a framework, a rule of thumb that holds up for most people in your position. You still have to run your own numbers through it. Now let me show you what actually happens if you ignore these three signs, next to what happens if you act on them. The gap between those two paths is not small. Picture the same 58-year-old, still sitting on that £450,000 pension, deciding what to do next. There are really only two paths from here, and they lead to very different places by the time retirement actually arrives. The first path keeps the pension contributions running, another £500 a month, with 40% relief for the next 5 years. By 63, the pot has grown to somewhere around £520,000. Draw it down and pay 20% tax on the way out, and you are left with roughly £416,000 net, on top of a state pension that also gets taxed at 20% because it stacks on top of everything else you are drawing. Every pound of it stays inside the tax system. Need a lump sum for a car or a new boiler or a family emergency, and pulling it out means another tax bill on top. The second path stops the pension contributions and redirects that same £500 a month into an ISA instead. The pension itself keeps growing on its own, reaching roughly £500,000 by 63, untouched by new contributions and quietly compounding without needing anything more added to it. The ISA, meanwhile, builds to about £33,900 completely tax-free. That gives a bridge of tax-free income to draw from first, while the pension sits back and waits for a lower tax year, or for a moment when flexibility actually matters more than growth. Line them up, and the difference is not subtle. The first path leaves roughly £416,000 fully taxable, with no flexibility attached to it. The second path leaves over £533,000 combined, with a meaningful slice of it sitting completely outside the tax system and outside the pension's new inheritance tax exposure from 2027 onward. That kind of flexibility tends to matter far more once you have actually stopped working than it ever did while a salary was still coming in to absorb a surprise bill. Most of the advice videos stop right there, because admitting the old pension first strategy has aged badly is not a comfortable thing to say. But the government has already changed the rules underneath it, and that is exactly why the next part matters, the specific steps you can actually take with this. So here is how you actually put this into practice, step by step. First, check what your state pension alone does to your personal allowance. At the current rate, the full state pension pays close to £12,548 a year, and your personal allowance sits at £12,570. That gap is only around £22. In practical terms, your state pension almost uses up your entire personal allowance on its own. Add nearly any income at all from a private pension on top of it, and you are already paying tax at 20% on it, right from the first pound. If that describes your position, it is worth pausing new pension contributions rather than adding to a pot that is only going to get taxed harder later. Second, redirect what you were contributing into an ISA, but with a specific target in mind, not just a vague habit of saving. Aim to build a bridge that covers 3 to 5 years of retirement spending. For someone who needs around £25,000 a year, that means building towards somewhere between £75,000 and £125,000 in an ISA. That bridge gives you room to delay drawing your pension, or delay your state pension if that suits your situation, until you land in a lower tax position. Third, before you touch any pension income, check what happens to your annual allowance. The Money Purchase Annual Allowance drops to £10,000 a year the moment you start taking a flexible income from your pension. If you are still working and might want to keep contributing later, Taking even a small amount of pension income now can lock you into that lower limit for good. It is worth using your full annual allowance of £60,000 while you still have access to it, before triggering that lower cap by accident. I worked through this with a 62-year-old engineer who was still putting £800 a month into his pension. He already had £600,000 in the pot and a full state pension coming. Basic rate taxpayer all the way through. When I ran the numbers with him, he was not upset with me. He was frustrated at the years spent chasing relief he was never actually going to keep. He moved that same £800 into an ISA the following month. So let me bring all three signs together and give you the one decision rule that can save you from the most expensive mistake people tend to make in their 50s and 60s. Three signs tell you it might be time to stop paying into your pension. Your retirement income is already going to push you into basic rate tax or higher on its own. The extra benefit your pension gives you over an ISA has dropped below 10%, and you are within 5 years of retirement. Or you are still contributing purely because stopping feels like giving something up, not because the numbers actually support it. None of that means you have been doing anything wrong. It means the plan that made sense a decade ago deserves a second look now. If you are in your 50s or 60s and you want a retirement plan built around the rules as they actually stand today, not the rules from a decade ago, hit subscribe. I am Arthur, and this channel exists for people who want real numbers, not generic advice dressed up as certainty. The best financial decision you can make at 58 is not to keep doing what worked at 38. The rules change. Your plan should change with them. I will see you in the next video.